Assalamualaikum. My name is Cik Dafina Alia binti Cik Ayub. I will explain about risk avoidance and risk prevention. Risk avoidance is a type of risk control which it will eliminate any situations or activity that could lead to a potential loss, ensuring that the risk doesn't happen at all or is reduced to zero. Organizations identify high-risk activities or situations through risk assessment process and choose to avoid them. By avoiding these activities, organizations reduce the chance of facing any negative consequences. So, risk avoidance is about staying away from things that could cause harm or problems. It's like choosing not to do something because it might be dangerous or risky. For example, if Aisha want to avoid the risk associated with the ownership of property, she should not purchase property but lease or rent instead. Next example, a restaurant owner choose not to introduce a new ingredient to their menu due to concerns about allergic reaction and food safety risks. And then, for the last example, a new founder decides not to work with a problematic supplier to avoid potential issues like disruptions in the supply chain and delivery delays. Next, risk prevention. Risk prevention seeks to reduce the frequency or likelihood of losses. Risk prevention focuses to taking steps to stop the risk before they happen. This strategy involves identifying potential risks early and taking preventive action to eliminate and minimize the chances of them happening. Organizations assess potential risks and implement preventive measures such as implementing robust policies, procedures and controls to reduce the probability of risk manifesting. As an example, a car is regularly checked to find and fix mechanical problems to avoid engine failures and reducing the frequency of accidents. And then, for the last example, a retail store keeps strict control over its inventory, including regular stock checks and measures to stop theft to avoid losses. That's all from me. Thank you.
So today I will discuss about risk reduction. Risk reduction is to reduce or minimize the severity of losses. It involves implementing measures to lessen the likelihood or impact of identified risks to an acceptable level. It aims to mitigate risk while allowing organizations to continue pursuing their objectives or activities. For example, a factory implements strict safety protocols such as mandatory use of personal protective equipment (PPE) and regular safety training for employees. This reduces the risk of workplace injuries. Next is separation or segregation, which is dividing or isolating critical assets, functions, or processes to minimize the impact of risk on the overall organization. It is also to prevent failure and enhance resilience against disruption. To do so, the organization needs to identify key assets or functions and implement measures to separate or segregate them to minimize dependencies and vulnerabilities. It involves dividing responsibility among multiple individuals or departments to prevent fraud, errors, or conflicts of interest. I have two examples of this topic. For the first example, in IT security, sensitive data is separated from less sensitive data. For instance, customer data can be stored in a different database from general operational data. This reduces the risk of exposure if one database is compromised. While in finance, different individuals handle different aspects of financial transactions, which one person approves payment while another processes them. This reduces the risk of fraud or error.
I will explain about risk retention. Risk retention is a strategy in risk management where a person or organization consciously chooses to bear the financial consequences of certain risks instead of transferring them to another party. For example, manufacturing company opts to retain the risk minor equipment breakdowns instead of purchasing insurance as the cost of premiums exceeds the anticipated repair expenses. Whilst a local restaurant owner decides to self-insure against minor property damage and liability claims by setting aside a portion of profits as a contingency fund. The second one is self-insurance. Self-insurance refers to the practice of setting aside funds to cover potential future losses or damage, instead of purchasing traditional insurance policies from an insurance company. Essentially, it's the process of taking on the financial risk for losses and handling claims internally, rather than transferring the risk to an external insurer. For example, a person might self-insure their vehicle by not purchasing an auto insurance policy, but instead saving money over time in a separate account. If an accident or damage occurs, they will use this saved money to cover the repairs or replacement. So next, we move to the third risk management techniques, which is captive insurers. Captive insurers is a licensed insurance company established by a non-insurance company to insure the risk of parent company. For example, a multinational corporation from a captive insurance company domicile in a favorable jurisdiction to provide coverage for its global property and casualty risks, promising risk management and cost savings, or a group healthcare providers establishes a captive insurance company to pool and share liability risks, providing coverage for medical malpractice claims within the network. The last one is risk transfer. Risk transfer is a risk management strategy in which a business or individual shifts the financial responsibility of a specific risk or potential loss to another party, typically through the purchase of insurance or by entering into a contractual agreement. For example, an IT consulting firm enters a contract with a software vendors that includes indemnification provisions, transferring the risk of software defects, and also intellectual property infringement claims to the vendor, or a logistics company purchases cargo insurance to transfer the risk of loss or damage to ship goods to an insurance carrier. This is for ensuring financial protection against unforeseen events during transit.
We have known that under a risk transfer there are insurance and non-insurance. As for non-insurance technique, there are hedging and hold harmless agreement. So hedging is a financial strategy that involves activities of buying and selling a commodity to reduce or limit the potential loss from a risky station or investment. For an example, a company that imports goods from abroad might hedge against currency fluctuation by purchasing foreign exchange contracts. If the currency changes, the contract helps to reduce the loss. Next is hold harmless agreement. This is when one party agrees not to hold any other party liable for certain risks, losses, or damage. Let's take an example of a construction project. A constructor might sign a hold harmless agreement stating that the project owner is not liable for any accidents, damage, or losses caused by the constructor workers. To conclude that both techniques allow and provide alternative businesses or individuals to reduce potential of losses and protect their interests.
Assalamualaikum, I'm Abdul Nadir Amin and my ID number is BNK2311030, and I will continue the subtopic of insurance. So let's begin the definition of insurance. Insurance is a financial arrangement where an individual or entity pay regular premiums to an insurance company in exchange for protection against specific risks. In case of a covered event such as accident, illness, or damage, the insurer provides financial compensation or support. So, the purpose of insurance is to reduce financial uncertainty and share risk among policyholders. And the common types in insurance is health, life, auto, home, and business insurance. As we move to the history of insurance, the history of insurance dates back to ancient times when early practices were developed to manage risk. Around 2000 BCE, traders in Babylon used contract to divide the risk during caravan trade, marking the first evidence of insurance-like practice. In ancient China, merchants minimized losses from shipworks by spreading goods across multiple ships. By the 14th century, marine insurance emerged in Italy, especially in Genoa and Venice, as formal contracts to cover shipping risks. In 1601, the first modern insurance policy was established in London. The modern insurance industry saw significant development during the 17th century. Following the Great Fire of London in 1666, this event led to the creation of fire insurance, with the insurance office established in 1681. Around the same time, Lloyd's of London was founded, becoming a key center marine and other types of insurance. During the 19th century, industrialization spurred the development of life, health, and accident insurance. Regulatory framework for insurance companies also began emerge, formalizing the industry. In the 20th and 21st centuries, insurance expanded into new areas like cyber risk and environmental liabilities. Advance in technology introduced online policies and personalized insurance product, making insurance more accessible and adaptive to modern needs. So, let's move to the fatwa in prohibition of insurance from the National Fatwa Committee. The firstly is Gharar. Other term is uncertainty. Conventional insurance contract involve excessive uncertainty regarding the term of condition, such as the timing of payment, the amount to be paid, or whether compensation will even occur. This type of ambiguity is not permitted in Islamic transactions. The second one is maisir, and other term is gambling. The nature of conventional insurance involves element of gambling, as policyholders may lose their premium without receiving any benefit if no claims are made. They may gain disproportionately if claims are failed. Number 3 is riba. Other term is ushur. Conventional insurance often involve investment that yield interest, which is prohibited in Islam. Premiums are frequently invested in interest-bearing instruments that are incompatible with Sharia principle. And the last one is ownership and risk transfer. In conventional insurance, the company assumes ownership of the premium, and the relationship is seen as profit-driven contract, rather than one of mutual cooperation or protections. So the Sharia compliant alternative, the committee endorses Takaful, a cooperative model of insurance based on Islamic principle. Takaful operates on the concept of mutual assistance, ta'awun, and share responsibility, where participants contribute to a pool of funds, use the composite losses collectively. Investment under Takaful are made in Sharia compliant avenues, avoiding elements of riba, gharar, and maisir. This ensure alignment with Islamic value while providing financial protection. This fatwa aims to ensure the financial practice align with ethical and religious principles in the context of Islamic teaching. Yes, sir.